there and there. Whoops. Don't know what I just did. When I have too many monitors on, it's like hard to keep track of everything. When I have too many monitors on, it's like hard to keep track of everything. I have too many. There we go. Hopefully that didn't echo back on anybody. All right, cool. So we're open right up against the next fib line. This is from yesterday's news. Well, yesterday's fan line. All right, rough as it looks, we got a 5 second leg for leg. We're accumulating here, so the expectation is a possibility of this being an entire leg. Let's run it to the mean. And then the break would be targeted up here around that 420, 442.25 area. Good morning, Ricardo. I don't know what's up with your audio, but I did have a question that came off yesterday for being able to get audio but not video in the live stream on the Discord channel. If you're having issues like that, you might go and manually update your Discord. It should have all those settings come with it where it can actually correct everything. Because I know the video is a tiny bit delayed when it goes out to YouTube there. All right, here comes our accumulation. Let's see if we get this break and run to our target. There's your erroneous Bollinger Band indication there. Bad connection at work. Some offices have some terrible internet connections or ISPs. It's like they're squeezing, a bunch of office staff onto a very, very small bottleneck for a pipe.
Can you hear me?
Yeah, I get you now.
Yeah, it's choppy, my connection. That's why I don't talk on here. So,
Gotcha. All right, one break.
but I got a new phone, so it might be better.
There you go. You'll upgrade the hardware trick.
I got the new Z Fold 4. You should see the screen on this thing, man. It's amazing. And I can see all the charts. It's beautiful.
Oh, that's awesome. That's a sweet phone. I've been kind of eyeballing that one. Man, it's just having trouble getting through this resistance, isn't it? This should be the last attempt. If it doesn't break with this next couple bars, this can go and retrace down to about 441.40. Testing support. Grr, it's so choppy. You can see that measured move stack up even better on the 1 minute chart here. There's your leg, there's your accumulation. We just need to wait for this to break. Either we'll get the 1 for 1 or we will get a rollover. And revision. Here comes a revision. No trade here. I think we're going to have to wait for this opening range to play out into the next setup before we can go and take a trade. Kind of Good morning, everyone on YouTube there. I forgot to put the setting on for the chat on the YouTube channel, but I'll add it back when we broadcast again next week. Um, Monday, I think, is a short day, and then of course Tuesday for the 4th of July, where the market's closed. We're just going to close it and go enjoy some fireworks and some celebrations, maybe some barbecue. Wow, here we go. We might get the break. Let's extend that. That's been a grindy, slow moving 1-for-1, huh? But then on Wednesday, we'll be going strong, full day. I expect some volatility on Wednesday, I think. Everything's kind of lining up for that. I'll show you why I think so when I go and open my Weeble chart in a minute. All right, we're halfway into the move. Come on, little feller, let's go. Anyway, I did make a video last night and I uploaded it. Um, I'm going to make a couple videos to attach to that later on to explain a couple things about how to identify the measured moves within the diamond and even within the head and shoulders pattern. Those measured moves are everywhere, and that's where your trades are. Like this one here is finally working out. It took forever. Forever is a relative term. This is a 5-second chart. But the 1-minute chart gave us a pretty clean setup. There it is, almost to our target. Bam, there's some profit taking there. We might get one more reach to finish out the whole penny. Watch that 8 period though, because that is threatening to fail right there. There she is. Got about 12 seconds left on that 1-minute candle, and there's a wick so far, so profit taking's already began on that candle. Pretty damn close though. Right to 442.20. Just about to the top of our box. When you get the horseshoe and hand grenade effect on drawing these blocks, you're going to have to kind of eyeball the mean of this accumulation to find those targets. And if you're off by a penny or so, the idea is as soon as you see rejection, take your damn profit. Just hit that close it all button and have a good day. That wick right there, dead giveaway right out of the top of the upper Bollinger Band. Even though it didn't give you one of these short entry signals, there should have been one right there. That's a Bollinger Band poke, genuine. So we're looking for accumulation now. We may even get a 2-for-1. Let me grab an equal box here. It's not likely here, and I'll show you why in a moment, but this can be the scenario here. Dig out the Weeble. Actually, that would put us right at 442.50, which would complete a 2-for-1. That is the top of our known liquidity zone here. We're going for it. All we got to do is breach this pivot and we'll be on our way. So known liquidity zones come from a place far, far away. That thing that we're in now, it's a parabolic gap up move overnight where it is. That thing comes all the way from over here. In fact, I might have dragged it at some point off of this wick. That or I might have drawn it on a 4-hour chart, and this wick is erroneous. It's supposed to be back here somewhere. Memory does not serve on that. Maybe I should start writing notes, but we know where we're at. We know exactly what to expect there. 442.40 met with a wick so far. And let's get the fan out. Accumulation in this zone is setting up. Eventually we'll get a little wedge here and it'll break, and it'll either run to that 442.75 target or it will make a full mean revision to about 441.90. There's one break candle. I'm going to draw a little angular right here just for a moment. It's right there. There's your little wedge. And we know wedges have the 60-40 rule. 60% chance of breakout, 40% chance of failure. And then they also have a very quick little stop grab is typical. And as long as it doesn't break this previous accumulation here, we could see a continuation out of this. Think of this as its own little measured move. Mean revisions right here. We just hit it. Oftentimes, a lot of people will get stopped out on this, and the traders on the institutional side know where those stops are. That's exactly where they are. They can see them right on the chart for the index. You can see all the orders stack up, and you know the difference between institutional orders and retail orders when you look at that depth of market. You'll see that they tend to line up on fives, on 5 points. And if you're looking at the ES, you're probably seeing either a 5 or a 0 on the big volume profile bar of orders waiting to be filled. And you'll see some little skinny ones right here where all the retail stops were. It's like we're okay because we're coming back through to the next revision. We're at 441.90. We already talked about that. That was right here. That was a revision of this leg here. So you got leg, accumulation leg. This is its own measured move. They're everywhere. Once you start analyzing the chop and realizing, hey, it's just little 1-for-1s over and over again, life changes. That is a revision right back to our resistance and our angular resistance on the wedge. Perfect reaction zone. Now watch for accumulation in this area, and we'll see if we can continue that move after all. Boom, right to the angular support of the wedge. It's pretty cool how you can draw some lines, run with the divergence on them, and you can see exactly where things are, meant to react. This one will do you even better. If you remember when I was always manually drawing these fan lines, we would see this all the time. Knowing where those reaction zones are can also be an exact trade signal. You can know exactly where to catch this trade. Above this guy, you know it's at least going here. That way you can have some profit captured in this move, not have to worry about a stop. A break above here, keep holding. We know where the target is. It's up here in the top of the box. Break below this guy, that's where your stop happens. Theoretically, we could take and draw a third line here. Just find any common trend line anywhere. Gives us roughly the regression line in this channel, although it's not equal. It's good enough for this wedge. We're halfway through the move. And this is where our stop can be lifted a little bit. Just follow this line. If you're running a stop at this point, you can also decide if you want to just have your finger hovering over the button to kill that trade the moment it breaks this guy. That would have did it. Let me extend this box a little bit here. All right, Ford came in, visited around 1498. We're back into strength. She is beast. Too far above 15 and we start getting into some unknown zones. I'll show you that on my Weeble chart later on. All right, so we have a 1-for-1 here, accumulation, most of a mean revision in this guy here, but it held support of our box. Can we get another trade here? Yeah, we're going to look for the break. We're going to look for a break above this accumulation here. So for that, we can just set a horizontal line on the chart if we want. So if this accumulation breaks us out into a 1-for-1, we get the same thing. We get the target to the top of our box, but we also get a little extra. Where's the fib line? Right up here. So we can take and draw a new box if we want to. Oops. Now take us right up to that fib line. So far we've got 1-for-1 done, accumulation, threatening to finish the 2-for-1. We know where all the control zones are on this thing with the angulars. And we don't have to be nervous trading chop. We can trade it with confidence. So if you got long off this bounce here, your stop is going to follow this arc here. Break too far below that, hit the button. That would probably have done it. If this entire accumulation takes us to about 10 o'clock, which it's looking like it will, we can start to analyze a couple other theories here. So if this becomes an accumulation to about 10 o'clock, we can build this entire section here as a move. And I'm willing to bet that would take us to about the mean between this fib and this fib. So I'm going to borrow our first box here. Find about the split of this mean, this mean of this accumulation here, and then just sort of drag your box right up on top. And it gives us about a split target right here to 443.40. This is going to be the key support for that right here. This is an old pivot line right here, 442.30. No, 442.28. This may break over here. Little micro double bottom. You got L1, H1, L2, H1 broke. Target 1 reached. That's target on this control bar here. Target 2's up here. 100% retracement of the move is right up here. That takes us to the angular resistance, still from our original wedge, back here. Alright, we're set to finish this move here. All we need to do is stay above this angular. We're just above the resistance of this accumulation here. Although we're starting to see some range expansion here. Let me borrow a couple lines. We'll show you what that looks like here. We could very well see a diamond pattern on this. We could see range contraction come out of this. Just in case we do, we'll draw a parallel to our angular resistance right down here. See, there's your first line. We're going to parallel that line. I'm going to get rid of this box. And probably this one too. We could go and draw our regression lines in here, but that'll make this 5-second chart really busy and our 1-minute chart practically unreadable. We don't necessarily need those yet. The idea is you can draw a parallel here. And it's just going to be parallel to the angular support from this range expansion. And voila, we got a diamond. So I guess I can get rid of our pivot line too. That might actually be valid right there for a move quickly to the angular support here. And your stop would be right on the angular resistance here. Failed. Never forget, there's a regression line here. It's weird how it transitions down here. It's parallel nicely on the 5-second chart. The 1-minute chart, it's like kind of Looks like Patrick drew it. Kind of adjust that a little.
Patrick who?
From SpongeBob.
Oh,
I don't even watch that show, but I love the memes that come from that show. They're hilarious. All right, add our regression line, add our angular support. Should I even bother drawing a regression line? I can. This is where we're likely to get one of those, one of the fake outs anyway. But we'll know if it crosses this line. I'm drawing it on the 5-second chart, but I'm watching the 1-minute chart to make sure it's not all confounded there. So we've got our diamond top. We may be invalidating our big 1-for-1 here. And right at about 10 now, we're coming to a point in the diamond. This is our angular support. This is our angular resistance. Any second now, we're going to see a break, and it will be probably pretty quick. The diamond pattern precedes volatility. The likeliness of repeating most of this move is pretty high. So you've got about a 60% chance of running most of this move. And remember, there's an angular here. That's where the actual target's going to be. Most people are going to try to chase it to that previous low. But there's also a 40% chance that this becomes a continuation pattern and runs up to the angular resistance up here. All we got to do is wait for the break, and we can either trade the break or we can trade the revision. Let me adjust that a little bit cleaner. There we go. We're going to need to know a very accurate place of where this regression line is going to be, as well as the one coming out of this side. All right, so we've come out of the angular resistance here. Haven't quite reached the previous high. It's looking like we're going to break to the upside and then probably rip down to the downside afterwards. Here comes a 1-for-1 target right up here, 442.80. Boom, done. That quick. So you can see how cool it is to be able to find exact targets with the diamond pattern. Even that wick, that was a 5-second wick. It happened in less than 1 second. That would have been a beautiful trade if you would have caught that. Just very fast. Hitting the market button, you would have gotten exited right here. This would have been best by setting a limit order right around the end of that sucker, just a tick or two below.
how would you get out of that?
That would have definitely had to have been a limit order, knowing where the target is up here. You would not be able to get that with a market order. No way.
That,
That happens so
Why?
fast. When you hit the market button, you're like the last one in the stack of orders that are waiting to be filled. So trying to catch this wick with a market order is impossible. You can do it with a limit order if you set it a couple ticks below where you expect that target to be. There was a very subtle little clue once we crossed the regression line here that it was going to do that. And those two bars came fast, and then that wick just boop right up to that target and down. So now we're playing in the bull channel. This is the output side of the diamond pattern. Likely to see a couple measured moves in this mix. Looking at the 1 minute, we got a pretty tall wick on that spinner here. This is setting up like it wants to be a 3-bar where we get a quick visit back down to the bottom of this bar. The other thing that we get sometimes is we'll get the bar spinner bar, as I call it, where we get a bar, a spinner, and an equal bar to the upside. And either way, the targets are already there. You got angular resistance or angular support. We're trading along the regression line. This move will be very quick. The idea is when you get a 3-bar, if it's going to be a bar, a spinner, and then a bar back to support, you trade the 4th bar in this situation, even though we have 2 dojis here. You would trade it back up through the regression line. But in this case, we got bar, spinner, bar. So if we get bar, spinner, bar, the typical retracement is going to be about a tweezer. You'll get an equal bar back down from this bar, but it will usually hit an angular. So that's complete. Let's see if we get a quick wick to the angular resistance and then a pullback. Hard to trade, guys, but that is still pretty methodical for picking out targets. All right, back to regression. Looking like a tweezer so far. We've got 2 seconds left. Nope, spinner. Watch the regression line. It's going to tell you A or B. A is measured move to the angular resistance, or B, mean revision back down to 442.50. This can be a challenging chop to trade, but it's looking so far so good. All it needs to do is crack a big bar right below this regression line, and we'll get a quick 1-for-1 out of that, or a quick revision. As time goes on, these lines are still moving upwards. So those targets are always dynamic, they're changing. So now we're at 442.53. We visited the low on the previous accumulation. It's a bit sketchy here. You can see that there's a control bar here. So now we're in range of this control bar. Back through regression. Didn't get our bear target. If you can trade that on the 1-minute chart, it'd be a little smoother. There's really not a lot that you can get for clear signals here, other than the fact that we have this nice, beautiful hammer right here on our regression line. But at some point, this channel is going to be tested from edge to edge. And that's what we're looking for. We're looking for the 1-for-1 that comes from that move. we don't have to trade the first leg. We want to trade the second leg. The second leg's easier to see coming than the first leg. And apologies to my YouTube and Kick fans. Lots of background noise here. It's a house full of summer fun. That is some creepy crawly chop, but we're still making that 1-for-1. There's your leg. Very hard to trade. Bam, edge, right there. When you get to this part of the bull channel after a diamond pattern, you can start seeing some interesting things happen. And we've witnessed this before in live trading, where we have a leg here, just like we see, and then we get a parabolic move outside the channel. We'll know when it happens, it has to breach this channel angular resistance first. So we have our target from our previous 1-for-1, and that's as if you were using this diamond pattern as accumulation for all of this move. So if we go parabolic outside the channel, we've already got our target. That's where this box is still here. But as time goes on, angular will eventually meet that target anyway, right? So if we get a quick move, we already know this is leg 1. And then leg 2 takes us almost to our target. So an overshoot would take us right to extension, 443.40. Rejection of this angular would just take us for a mean revision right back to the regression line.
There seems to be a gap up on the daily for SPY.
Yeah, it is. It's an incredible gap up. I'll get a couple seconds and show that on my Webull chart. Looks like we're aiming for mean revision or accumulation right here. Let me zoom back in on that. I think I might have a second, but watch this thing explode right when I flip charts. So here's our old diamond pattern from yesterday, and we're still relevant. Kind of neat, huh? That was all the way back here. We're just outside of it. We're through. We made a full A to B and an overshoot on our known liquidity zone. And the idea is, if you look at the daily chart, turn the drawings off for a moment, that's one hell of a gap up. But look what we're hitting, previous high. This is a bit ominous. We can either get a big old double top and a massive quick closure of that gap. Could even happen on Monday. So like, let's say this daily candle becomes a big doji and it's hanging right up here in space. We've seen that before and it wasn't pretty. I'm going to take you to the Wayback Machine. That one right there. That was a very fast drop down day, and it reclaimed the entire gap in this whole big bar spinner bar setup here, ripped it all the way down to a mean revision, and then straight to the bottom of accumulation day. So always be careful when you see a daily candle like that. Here was another one. We got 2 spinners in a row. Confidence was lost. There's the daily 200. Blam, gap down right to the bottom of the structure. And then even further, it made a right shoulder and ripped the rest of this. It was pretty easy to trade all of this. We were here. That was some good days. But now we're in an area where we're looking very double toppy, and it's a gap up to get there, so this is kind of iffy. The other scenario is we've been in this before too, where we had a nice gap up in accumulation in spite of closing spinners over and over again. We eventually legged this whole move out. We've got this as our base leg, and this was our 1-for-1. So it can still go higher. The market can always keep buying. Greed will do what it's going to do. But there is a chance of a very rapid pullback or a very rapid gap fill or sell off, if you will. Just kind of always be aware of that when you start seeing parabolic moves like this. Trade in a day trader's mindset rather than a swing trader's mindset. So you probably won't see as many swing trade ideas come out of me this week. Next week, probably. This week, I'm a little leery on them. I'll dig through Kramer's list in a little while here anyway. But I'm not sure I'm going to find any great setups. All right, let's go back to the fan. Right in the angular. Nearly made completion of this 1-for-1. Got about 50 cents to go. It's got to leave this channel parabolically to get there, though. And we're making another range expansion right here. I don't think we need to draw this one. It's pretty easy to eyeball. Looks like we're out of it on the 1-minute chart, though, doesn't it? Yeah, kind of at the edge of it. We'll probably see some range compression here. Probably hold the angular on the regression line. And this is setting up for a move by about 10:30, it looks like. Very, very hard trades here. I won't even mess with this part of the chop. I'm going to wait for the outcome.
I've been caught up in the chop too many times to jump
Yeah,
in today.
it's better to be patient. I mean, although it is melting up, it's nearly completing its 1-for-1 from base to accumulation. So like here's your base, here's your accumulation. This is your expected move. It may take all the way till about 10:30 to get there, just riding this channel. So you can swing trade this, but trying to scalp these little moves, damn near impossible. We had one good one back here when we had that big wick right there. That was it. Now we're just waiting for this to break.
Yeah, so on that wick, the one you just showed right now, I took $30, and that's been my only trade.
Hey, that might be the only trade. That's good. That was a good quick one.
Yeah,
We knew the
I
one
made my
trade was good.
daily profit today, so hopefully stay disciplined.
Now all I gotta do is keep it, and getting chopped up in this would be pointless, even though we're still trending. So like for me, typically what I would end up doing is I would go scalp this stuff on the opening range because that's much easier to trade with futures, and then I would go and have switched to options as well, and then run my passive trades in this trend. Meanwhile, I'm waiting for some other things to set up on equities, but I'm not really seeing much opportunity. Here we go, parabolic. Looks like we'll get that hit to 443.40 after all. Oh, we are right there. That was the first move. That happened. That's measured move from this leg here. That target met right there. Perfect bar. The extension will be still at this 443.40 target, but it's going to accumulate on top of the fib line first. Pretty cool day for being able to identify structure within structure within structure. That's for sure. So we got 1,000 little moving parts to the one big part. All right, back to the 8 period, closed a 1 minute candle on the 8 period. This next candle will be a signal candle. We might get a quick down leg from this. And if you watch the 8 period here, it's going to tell you what that candle closed first. And Tesla and Amazon are just humming. All right, there was your signal. There's your bar down, right to regression. Quick 1 for 1. Pretty much done here. That was a nice little leg. Target met. So you had a close on top of the 8 period, and then as soon as this candle went below the 8 period, that was your trade. And we were able to take that right here. Again, 8 period trade. Bearish move, 1 for 1 bar. Target was down here. Even though it's extending all the way from A to B in the channel, that trade could be taken right there.
You're telling us what to do, and I'm still not getting it.
It's okay. Learn. You know, you don't have to take those trades.
What to do. No, I'm not. I'm not saying like telling us in live, but you're telling us what to do, and I'm still looking at it like,
It takes a minute. It'll be some deer in the headlights, and then at some point it'll just click like, aha. And you start to see it for yourself. That's when you get the confidence to take the trades.
I was looking at this and thinking, oh yeah, this makes not perfect sense, but this looks like a good low risk sort of strategy for getting into like small trades, which is ideal, low risk.
Right.
Not like a low probability, but a low risk and overall low risk strategy. And then I sort of like turned my head to go and look at something else and forgot about it for ages. And now I'm coming back to it. I'm like, oh, what am I trying to do? But you're telling me what to do, and I'm still sort of looking at it, thinking you don't. So you've got a rate, you've got like the lines. You don't trade the whole line to line as the trade. You wait until it's within the range of the lines, yeah.
Right. So you have to
And
identify
you,
one half of a move or one measure, identify the accumulation,
oh,
and then trade the second half of the move.
oh, the one for one always happens within the lines. I thought it was like from one line to the next is the one, and then from that line to the next is the other one. But it's not. It happens within the lines, within the fan lines.
Typically within the fan lines, and then typically within structure. So we have our structure. We have our bull channel. We have this guy here as angular resistance. This is angular support. We could have taken this all the way down. And in hindsight, it made a 2-for-1. So we got a leg here, accumulation, continuation. That's one
That's
leg.
the one for one.
And
Yeah.
then the 2-for-1 is all the way down here. In fact, it overshot a 2-for-1. Now we're in the zone on the divergence of the first diamond pattern. So we don't like to stay here very long. It'll either A, come back into the bull channel, or B, it'll go from bull channel to bear channel.
You know these are diamond pattern lines, right? Okay, and you're saying the one for one measured move happens within the lines. Does that apply to the fan lines as well?
You can apply it to the fan lines. Anytime you see a structure, you can identify that structure. It gives you all the price targets, and they're still within different fan lines. This is still yesterday's fan lines. So we're just identifying where those fib levels are from yesterday's action.
Right. Okay, thanks, Jeremy.
So what I should do, I should go ahead and move our fan lines up, probably start them over in this guy here, or I could do it into this diamond pattern here. Let's do that real quick. Give us a little bit of edge on drawing. So I'm going to delete the old fan lines. And we can start them right in the center of this diamond pattern here. And then just leg your comment up this way. That could probably give us some good fans for today. Seems to be legit, lines up with everything we've seen. But we want a little bit closer. Let me shrink this down a little bit, make it easier. So we actually want to drag this, let me see here, I'll do this as point B and this as point A. That gives us a little bit better short-term action right there. So we have our diamond structure, we have all of our current fib lines, and we have a probability of pause here on this fib line here if this is going to break down out of this channel, the bull channel, and come into accumulation. There's a fib line right here, and it also strikes at about the middle of our diamond pattern. So when you start to notice commonalities between two different analysis styles converging, you can get some really quick trade ideas. So it's looking like we're making a transition into a new trend.
Well, I'm gonna take my profits and I'm gonna go.
Hey man, paid for your lunch and then some today. You got lunch and a handsome tip.
Yeah, definitely. Have an excellent weekend, everybody, and good luck in the market.
You too, man. Thanks again for joining us. Enjoy the
Take
Monday.
care. I'll see you guys on Monday or Tuesday.
We'll be here Monday, and then Tuesday we're gonna close the market for Tuesday, and then we'll
Yeah.
be back full strength on Wednesday.
In Canada, we celebrate tomorrow, Canada Day,
There you
but we get the vacation on Monday, so it's a long weekend for us as well.
go. There you go.
All right, guys, take care.
See you, Ricardo. Here in Britain, we're going to regret losing all the colonies, so we're not doing any celebrating.
I don't know. That might be the we dodged a bullet there day, I guess. I'm teasing.
No, I know.
like
Thinking of it, like Canada, US, all these countries are like, yeah, we celebrate independence. It's like, yeah, I don't blame you.
all right,
So, Jeremy, now you can close the markets. You got that kind of pull, huh?
I guess so. No, it's going to be closed forever on the 4th of July unless we become a new nation.
Could happen, I suppose.
Yeah, it's the way things are going. You never know. It's pretty nuts.
Yeah, some days, man.
I mean, I try not to dwell on politics, but dude, you can't help but notice them.
Are you going to become like independent, different states and stuff?
You know, I mean, that's kind of been an ongoing thing, and I think mostly it's a distraction. I remember back in the day when they wanted to make California a sovereign nation, separate from the Union at one point. And then later on, they wanted to split California to Northern and Southern California, but calling one half of it Camelot or some weird, goofy, dumbass name. And, it was laughable at the time, but there were people who were actually serious about it. So that makes it a little less laughable and a little more laughable at the same time, I guess. Um, but you still have this kind of stuff going around. You've got, everybody kind of taking sides on gun control and race, and sex and creed and all this stuff. And it's like, stop the damn division. Just understand that we're all part of the same nation. And then things start to make sense. It's like, well, what's the real problem here? The division
I still have
itself.
a bag. I still have a bag packed marked Texas.
Yeah. I mean, Texas could be its own sovereign nation. I mean, it's got
Yeah,
everything it needs to be one. You got a port. You've got plenty of land to grow crops on. You've got plenty of industry.
they got oil.
They got oil.
Oil, yeah.
California, you can't do that because they're gonna the EPA controls oil. It's there, but you can't touch it.
Hey, they got solar panels. It's all right.
Oh yeah, there you go. Yeah.
That's all right.
When the sun shines.
Yep. There we
Lots
go.
of wind turbines in the canyons.
Yeah. But then they lose all their bird population. Here's our regression line. We're back. Looking like a quick 1-for-1 might get out of this. Let's subdivide that a little bit, though. We got a short-term target. It just wicked it before I could draw it. Damn, that was so fast. Exactly when I finished drawing that line. Boop, right to it. Watch for accumulation along the original regression line here. And we'll see a split. So we'll see a quick leg, where it's going to equal this leg, likely. And it's going to be split with a little pause right at this division line. That's my prediction. But remember, I always say, react, don't predict. I've been saying it recently. And then once we finish that move
That,
up,
that's really the key to it is, I mean, you can draw it out and you can see the levels, but identifying where are the levels and which way you think it's going to go is really the key, right?
right. And then the other part to add to that is don't trade the setup, trade the break. That way you are reacting and not predicting. So here was the setup, and there's the break right to base of our channel. So instead of making a 1-for-1 up through here, we've made a mean revision. We're back to here.
And I started new fan lines this morning, and they're still right, showing the same levels. So
Yep.
you're right. It doesn't matter when you start them. It matters. It matters more if you draw them right.
Right. The idea is you need just one common trend line to make that work, and that common trend line can be found anywhere there's an accumulation of any kind. Even an accumulation within a trend can be valid there. So like back here when I drew this, 0 point was here, I came way out here. That's just a common line within a trend. It was trending up. There's your common support line. And then you get the fan on both sides. So we have all these relevant lines up here. Well, we've got a zone that we're in. If we wanted to move it up here, we could. We can start an A here and bring the common line to here. We can start an A in this accumulation break right here and bring a common line up here, here, or even to here if you wanted to. And it would all set up the same output. Whoa! We're in the no man's land. We're in the divergence of the diamond now. Strong. Right to our fib fan line.
Heading to VWAP.
I bet. Volume weighted moving average would be about there, yeah. I haven't used VWAP in years. I started dabbling with it a little bit early last year. And I was like, it's pointless because I can also see exactly where that price action is expected to break just by drawing lines.
Well, I think VWAP's important to know because everybody uses it, not necessarily that you're going to use it, but
Right.
that's what so many people use VWAP.
It's good to know about where it's at, yes. Because you know that's kind of going to be a magnet for price. And it's exactly why. It's because everybody else is looking at it. That's what I love about what I do because I'm looking at stuff that not many people are looking at. But I can come up with the same trade ideas, only I can take advantage of more precise movement. So I can take advantage of more precise entries and exits doing what I do. Finally, break down Starbucks. Let's go. I've been waiting for this swing trade to erupt for a long time now. Too long. But if it gives us the break I'm looking for, we get a 2-for-1 measured move out of it. It's got to break the floor first, but we're starting to set up something interesting here. And it could take a few more days for this to shake out. This is a big old diamond pattern, isn't it? So we've got range expansion. We're in the range compression side. Where's the break? It's probably not going to happen until about July 10th or 11th. But if I start to see
I've
the
been waiting I wanted to sell a put on Ford so that maybe I could get it, but it just keeps going up.
it just keeps
Jeez.
ripping. It won't stop. And I kicked off the calls I had back in here. I took good profit on them, but I mean I could have did a lot better just holding on or flipping that position into a spread. It's okay though. It's a bit of JOMO. Yesterday would have been a great day to swing into a neutral position and ride it again, but I missed the opportunity. I was pretty busy yesterday.
Well, my simple strategy was to wait for a forward pullback to sell a put and then take advantage when take advantage of it so that but now the price on those puts are just so low, so it's not really making any sense.
Right. Another part of the story is this is looking like we could see that thing hit $17 with the full measured move here.
Yeah, I mean, it seems to me like it would be better to buy the stock right now than it would be to trade an option for me anyways on my simple, trying to do a simple thing. So
Right. So if we took this and built a measured move, where would it be?
I mean, I was trying to do the wheel strategy, starting off with selling a put, and then if I ever get a sign, then I'd do a call, but
Right.
can't do it right now.
Yeah, it's just not enough value in the puts, and the move's parabolic, so the risk is higher. The risk of eating crow on an assignment would be pretty dire in that measure. You could do it with an adjustment to that strategy where you start with 100 shares, just buying the shares and then selling calls and puts. But in my opinion, Ford doesn't have the greatest yield approaching it with that strategy because you're going to be long 100 shares and then you're going to be um, intrinsically long another 100 shares when you sell the put. And if you can't make enough profit or enough premium on that put to keep your cost basis underpriced should it turn around on you, you're going to be in trouble. And then the covered calls are not going to keep you within the curve of the price decline. So if it takes a rapid turn and starts running down through the fib lines back to like $11, you're going to be in trouble. You're going to be upside down in that. It'll take many months to recuperate enough return on the premium to balance your cost basis with price. So it's kind of too much risk and not enough reward at this point.
Yeah, that's exactly what I was seeing was I'm like, it's just not worth taking this for this little tiny put the little premium I could get.
Right. The other idea is there is one more strategy you can use that actually would be fairly fruitful. Let me look at the chain and verify it first. We could do something similar to what I did to Amazon when I was having not a same issue, but when I was having a yield issue. Let me look at the chain real quick. I'll see if I can come up with something. Okay, so current share price is 15.12. Damn, that's a weird strike. I'm looking at January 21st, 24. Let me go to the 19th. Nope, those are weird too. Grr, we'd have to go even further. Yeah, those are straight goofy. It's doable though. So if you look at June 20th, 2025 expiration, that's way the hell down the road, guys. Now, let's look at June
Okay,
21st.
what are we looking at there?
Actually, let's go to June 21st, 2024. That's a little more reasonable. So when you're looking at a leap, there's one thing to know. Deep in the money puts tend to trade pretty close to intrinsic value. So The theory is if you either A, sell one that you get assigned on, and then upon taking assignment, immediately buy a deep in the money put, equating it to kind of lock the share price in. So as share price moves, the put is going to move intrinsically with it. It only gets us about a 30-cent boundary here, so it's not very much, but it locks it within 30 cents. So the way you would do that is look at the break even on the puts. So I'm looking at, this is way the hell out there. The short put would be the $19.35 strike. Break even on that is actually $14.67. If you were to sell that and get assigned on it, and there's not much open interest there to boot, so it's going to be pretty iffy to even get that thing open. But if you did, and you got assigned on it, your cost basis per share, less all the premium you sold for, would be about $14.60 or $14.70, somewhere in there. At that time, you could take an assignment on that and then either go to the next strike up, which in this case would not be very fruitful because it's all the way at the $20 mark, or you could go and after taking assignment, your cost basis is $14.70, also buy a put, the same put. So then you would take assignment on the 1935 put and then buy a 1935 put, and that would lock your share price. Okay, so your share price would stay intrinsic as long as price never crossed that $19.35 strike. You could continue selling covered calls on the thing in this parabolic move and probably sell bi-weekly. So you'd be looking at July 14th, you'd be selling like 1550 calls. The only caveat is if price explodes and you end up getting assigned on those bi-weekly covered calls, you immediately have to close that put. And you've got about a 30-cent window in that put to do it. So if price runs to 1550 and you end up getting assigned on the covered call and you still have that put on, only you don't have 100 shares to protect with that put, you're going to be in the water pretty quick. And you've got a 30-cent window. So if the price runs to 1580 all of a sudden after assignment the next day before you could go and close that put, you're going to have a hell of a time. What I mean is if you take assignment and it's after hours, you're powerless to sell that put for profit until the next day at 9:30. And if price happens to take a 30-cent run within that window, you're going to be at break even. You're gonna have gone nowhere in the first sale of a covered call. If you can make it past that point and begin continuing to sell bi-weeklies on the thing after that point, the income from that covered call, if you get to keep it all, will work against your average cost basis, but you've got to divide it by 200 shares. So the yield is not great, but in theory, it will keep you ahead of a curve if it pulls back and starts ending up in risk. So you've taken a lot of the downside risk, or almost all of the downside risk, out of the trade at that point, but the upside risk is still going to be present. It won't be infinite, it'll be controllable, but it will be there. So then you have to ask yourself, is the yield really worth locking this thing in with a leap put in the beginning just to sell covered calls on it? Something like Amazon became very apparently worth it when I did that strategy, but it did tie up a ton of capital because I had to be long the put and long 100 shares. And in doing so, I made pretty good returns selling covered calls against it for the better part of, 7 weeks, I think I held it. I was able to do pretty good returns on the covered calls, But in the long run, the risk was always there. So if I got a sign on any one of those covered calls, I still had to take care of that put immediately the next day. So there was still some risk there, and Amazon could have exploded in price at any moment and pretty much wiped out every bit of profit I made selling covered calls on it. So
Ford's pulling back really hard.
nice. Probably going to tap that $15 mark. And notice SPY is coming right down 1-for-1 straight through our fib line onto the next fib line. We've broken the center line through the diamond. And where are we running? We're in that no man's land on the divergent side of the diamond pattern, and this is where price doesn't like to stay for very long. We have a pretty good chance of running a 2-for-1 down through this guy over to this guy. So watch for accumulation here. It'll give us one more trade. But anyway, there's a lot to think about when it comes to running income option strategies. And when something has run away from you like this, you've got to figure out what your risk to reward is if you want to even pursue that. Or there's one more fallback: patience. Eventually, this is going to set up in a range somewhere. It can't be parabolic forever. And if you look at the daily chart on Ford, it's been parabolic for quite a while. It broke an angular resistance. We do have a possibility of finishing the 1-for-1. I just drew this morning. But look where it takes us. Mean revision. Right to this previous high. So if we see that come to that previous high and settle around there and start to accumulate, now we've got an opportunity to take advantage of the wheel trade. Even though price ran away from us, we can wait for it to finish its move and come again another day. In the meantime, the options chain is cheap enough to where you can trade just options instead of taking, position in the shares. You could cut that risk into pennies on the dollar, trading the biweekly options rather than selling them. So instead of going and selling a cash covered put for peanuts, you could just trade the volatility. So you can run strangles. You can run swap strategy. You can run just a single leg or a strangle, and then just run swaps by selling short against the longs. So you can have synthetic long positions. There are many ways to look at options trading and many ways to use different strategies to do different things with what your expectations are. But there's also a way to hedge pretty much everything you do with options, whether it is intrinsically or synthetically. So risk is always defined. And when you start throwing synthetics around, you'll be able to understand that you don't have to put out so much money to maintain a balanced or self-hedged position like I described with the long leap put. There's many ways to kind of dissect that frog, so to speak, but there's also a meaning behind it. You've got to figure out what your plan is. You've got to figure out what you intend to do with the price action that you're seeing on the equity that you're interested in. And one same strategy will not fit all equities. There's different strategies for different equities. And the combinations and possibilities are damn near endless. All right, so SPY came through our fib line. Now we're making our mean revision. We're running right back up to previous high. We've set up a leg in this mix here. We've got an accumulation. Measured move would take us slightly beyond a mean revision to about 443.15. Back to the fib line. Mean revision's basically complete here. We could see this step up a 1 for one leg. 443.15 would be about the target on that. Just kind of eyeballing this one. That pullback on Ford is genuine. Printed a tweezer bottom, made a mean revision out of it, back to 1412 or 1512. Could see it stabilize and start to accumulate. I'll wait this one out on SPY and then I'm going to probably sign off for the day. It's been pretty fun. Choppy, interesting, got a lot of knowledge out. And then there's options. My gosh, we got lots of options. I'm slowly putting together some material on options. I've got to write a lot of stuff out before I start making some complex videos explaining some of these strategies. In fact, I'm probably have to break it down into several small pieces so that it gives you a chance to learn and experience these little pieces of the big pieces before you start getting into some really complex options trading. But it's pretty cool to experience it and then understand in a whole new way that there's so much more to options than just trading them.
One thing I'd love to see, Jeremy, is how volatility in the market affects the value of the options. So and like some examples of like early morning trading or a big market event and watch what happens to the options, you know.
Right. Yeah, you'll notice implied volatility has some pretty drastic effect on options values, especially leading up to a known volatility event, like, literally seconds before J Powell takes the mic. If price was flat on SPY until the moment he took the podium, you could theoretically take just a strangle position on a 0-day set of SPY and then have both legs be profitable if price remained about flat within about 40 minutes to him walking up to the podium. You could have both legs be in profit just because of the implied volatility swing. I've been there and done that. It's quite exciting to where you take a neutral position and you kill both legs of that position like seconds before he touches the microphone and make profit on both legs. The way that has such a dramatic effect on the options chains because supply and demand increases, and so does the actual volume of trades on those options. So suddenly they become very desirable, and thus supply and demand has an effect on the options chain, even though price isn't really going anywhere. Another way to take advantage of that is you can look at some of the big parts of SPY like Apple and Amazon and a couple others, and you can take a flat price action day that kind of leads up to old J Powell taking the mic, and just before he takes the mic, you can sell the open options on a wheel trade in those equities, and in seconds you make a killing. Because the moment he picks up the mic, all of a sudden the volatility will drop off on that, even though price is going wild. And you can go and buy back to close those options over about a 15 or 20 second period and just be blown away by how much profit you can take in seconds. It's kind of an interesting thing to do when you start to study options that close to the cuff and you start to watch them and you start to understand the different effects that volatility in the market will have on them. It's even better when you can decide that there are many different ways to take advantage of that are well above and beyond the simple buying and selling of options or the day trading and swing trading options. But yeah, there's
that's good stuff right there.
a lot of stuff to consider when it comes to that volatility effect on options and how fast and how far it can move them. And the biggest thing is watching the multiplier change. So I've had to adapt the strategy since the advent of having 5 expirations a week on SPY and Q. It used to be 3. It used to be Monday, Wednesday, and Friday. And when I would trade them, I would look for anywhere from 2 to 5 days to expiration on back when they had 3 expirations per week. I looked somewhere between 2 and 5 days to expiration, and I'd wait for about the middle of the day, and I'd flip through the deltas, and I would look for stuff that was like 0.06 delta or lower. And the reason is that I could go and day trade those on SPY and Q, and the delta would move the price exponentially. So I would have like consistent 100%, 200%, 300%, in some cases 500% returns on those options at that delta level. And it was just easy. All I had to do was get the price action right. So if I had a trend, I could go and scalp each move of that trend, each leg of a measured move within that trend, whether it was a 1-for-1, a 2-for-1, or a 3-for-1, over and over and over again, and rotating the same risk into a new strike each time I would trade a pause in that trend. And it was just incredibly easy. I made a very, very good amount of money to a lot of my financial things with that strategy. And then it changed. Then they started having 5 days a week expiration. So the delta theory that I had, the sweet spot of delta, shifted. And it became less fruitful because there was more dilution of the actual traders participating in the options chain because it was spread across 5 days instead of 3. So now I had to find a new sweet spot. And I kind of did, and it worked for a little while, but then changes in general volatility in the market would skew that theory quite a bit. It made it hard to be consistent. So I would go and look for the same delta area around 0.06, and I would notice that the chain would kind of fluctuate, and the time decay was actually increased a little bit on that. So it went from being a stabilized theta that you could rely on to being a slightly higher amount of theta. So time decay started to affect those. So your trades had to happen over a much shorter time. At around the same time, before the strategy came into effect, a lot of the day trading, short expiration options trading happened on Robinhood, of all things, and on Webull. And they both had the same cutoff time. After 3 o'clock, you couldn't buy to open any 0 days. You could only sell to open or sell to close. And it would have an auto liquidation that would happen at 3 o'clock. So if you were in danger of
Federal
assignment,
Reserve Board issues
or
enforcement
you
action
didn't
with
have enough
Lakeshore
capital
MHC
in
and
your
Lakeshore
account
Bancorp
to
Inc.
exercise those options on 0 day, it would automatically liquidate them for you in the last hour of trading, which is kind of crappy if you ask me, because a lot of the action happens exactly after that flashpoint. Suddenly the price moves. So it's almost as if market was being influenced to keep a tight range and keep those options expiring worthless as much as they could, or reducing the value of those options to a fine point that would happen right at 3 o'clock. It was just insane to watch. You swore the market was being manipulated exactly to do that. Maybe it is, but it made it very hard to be consistent trading the middle of the day option swings. So now, since the 5-day expiration, Robinhood has bumped that out to a 330 auto liquidation target. And not many Robinhood account holders have enough equity to exercise SPY options. I mean, it takes a good chunk of change. So a lot of those speculative traders in that last hour will go and enter a 0-day position at 3 o'clock, which is damn near suicide unless you've got a bitchin' setup, and try to be out by 329. And price would almost always look like it was going to run. It would be a trap, and then it would fail, and it would just be locked, and the value of those options would evaporate. So suddenly, you look at the 3 to 5 day to expiration chain, and the time decay would increase, but the delta would stay pretty flat, and implied volatility would stay pretty flat through the middle of the day. You wouldn't get the consistent swings of being able to knock out 100% return on risk in that sweet spot. It just didn't happen anymore. So around that time, I realized, hey, there's a better way to do this. What is the one thing you can do when you're intending to day trade or overnight trade options that doesn't necessarily eliminate time decay, but can reduce it incredibly? That's where debit spreads come into play. So you're buying to open a long leg and selling to open a short leg at the same time. And the time decay on that short leg is relatively close to the time decay on your long leg, as long as they're pretty close together, within 1 or 2 strikes from each other. Then the game changed. Now we got consistency again. The only downside is we don't have nearly as much delta shift because you're short one option. The delta shift in the short option won't change as dramatically as the delta change in the long option, but the difference between the two won't be much as they're closer together in the $1 spreads. The $2 spreads, then you had something. Then you had enough delta shift between the long and short to make use of it. But it cut that delta shift in half. So instead of making consistent 100% returns, you're looking at consistent 50% returns. It's still pretty damn good for options trading, right? So now you have to calculate what your average delta is when you build those debit spreads. And that's why I'm looking at the pain zone on a 0-day. I look for those options that are trading between 3 and 4 cents a piece. And if in the middle of the day, around noon to 1, they come down to about a $6 or $8 width, meaning the difference between the call and the put at about the 3 to 4 cent range shouldn't be a total of more than $6 or $8. Anything above $8, risk off. I don't mess with it. But if it comes down to being about $6 wide, it's the sweet spot. And then I start looking at the debit spread trades within that. So that 3 and 4 cent option would be my short leg, and the next leg closer to the money would be my long leg. And I'd run those debit spreads on that and be able to make consistent 50% returns, either day trading them or swinging them overnight, as long as they had a couple days to expiration.
That was a little information overload, but thanks.
No problem. Hold on one second. I'm going to be back with more. I just got to talk to my wife for a second.
All right.
Sorry, I've got more. So, yeah, that's quite a bit of an overload there. And if we got this on YouTube, it's in the public channel. Be sure to watch the last parts of this again to get this. I'm going to try and clip it later if I can. The other part of this is looking at the 0 day, figuring out where the pain zone is. But I'm not trading the 0 days. I'm trading the 2 or 3 to 5 day to expiration, but at the same strikes as the 0 day pain zone. So if I'm looking at $6 wide and I want to build a condor, that's where I'm looking to build it, because I know the strikes around that zone with a couple days to expiration, I can get within a risk of about typically 4 to 8 cents, somewhere in that neighborhood, on a $2 wide in that range. When price is kind of towards the middle of the day, the implied volatility is as tight as it's going to be or as low as it's going to be, pending there's no news events. And I can build those condors if price is just wiggling a little bit and lock in profit on them and then swing trade them either overnight, or very rarely I'll swing trade them to the 0 day, but I like to swing trade them overnight. But that's the theory I use to build those, is this finding out what the pain zone is on the 0 day and then looking for 2 to 5 days is fine. If I can get a 5 day, it's pretty rare, but I'm looking in that range of time to figure out about where I can take and build a condor. And this takes me to the final part of finding the sweet spot in the delta. The reason for trading such low delta options is not to be discouraged by the risk in it. So if you look at such a low delta, it takes a lot of price movement, a couple dollars almost, for that delta to be high enough to make that option gain in value versus your risk that you purchase that option for to move to 100% return. So like, let's say you purchase that option for like 6 cents and price moved a couple dollars in your favor and it's worth 12 cents. That's 100% return. Okay. That's a very low delta. It takes quite a bit of price movement to make that delta worth a damn. And most people will focus on a 0.3 delta, which is pretty likely to expire in the money, is why you see that 0.3. The only problem is they're making like, a 5 or 10% return on the option. Whoop-de-doo. They can only buy a few strikes with whatever they're trading with. I can go and take a 0.06 delta and run them by the 100. And I'm taking a much lower risk and a much higher percentage return for the same dollars that they're spending to take a 15 or 20% return. So it makes very, very favorable returns and fairly low risk. The best part about that low delta is if price moves away from you, that delta moves slower. So that delta is the amount of leverage in the position, and if you're on the wrong side of it, it's less leverage against you. So you have time to get out of the way for a minimal loss, because a couple dollar move on a 0.06 delta might change that delta to like 0.04. And that is going to be, let's say you take a 50% loss on that position. You paid 6 and you got to close it for 3. Yeah, you take a fairly sized loss on that if you're running those by the hundreds, but compare that to your winners. 100% return wipes that loss off once. When you start making these incredible swings, 2, 3, 4, 500%, a couple of those is going to wipe out all your losses, especially if you're trading from neutral. So that's pertinent to SPY and QQQ. That's going to be great strategies for those. All of that goes pretty much out the window when you're trading equity options. Like you go for Starbucks or Ford or Tesla or any of those options. That's going to be better to play the same strategy, but in the month to 45 day expiration. 30 to 45 days expiration is going to be where those strategies can play with that kind of delta theory or that kind of sweet spot. So like when I was talking about, making the risk on those Tesla spreads, those $5 wide Tesla spreads, where I've risked like 4 cents per contract spread and then sold them for like $2.50 later. That's using the same theory that I use in SPY, but adding a buttload more time on it because it's going to take a while for that price to move. So certainly use SPY, use the shorter term trade outlook to develop the strategy of being able to day trade and swing trade these options chains like this, particularly with debit spreads. Use that to get the repetition to hone your skills for being able to swing trade it on larger equities or direct equities later. And all you got to do is find a good setup. So like I can go and pick off CNBC's watch list, find 1 or 2 decent setups out of it, out of the 10 or 20 stocks that they mention, and just trade those, because the fact that they mentioned them brings a lot of attention to them. It brings a lot of implied volatility to them. It brings a lot of opportunity and price options or price movement to that equity and gives you great trading experience being able to swing trade the move. So it's all in concert with price action, but man, when you find the right strategy for options that works for you and you can build and hone that skill on SPY and then take that into equities, all of a sudden you get an advantage. And you're going to be kind of messing up. You'll take some losses doing the SPY thing, but you're going to learn a hell of a lot about how they move. And then you can apply that to a longer time frame trading equities and really make some killer returns on that too. So it all come together, guys. And I got like probably just in the stuff I've mentioned in the last 20, 30 minutes here, I probably can make about 15 or 20 videos explaining each part of that. Definitely a lot to go over when it comes to building a library of options trading instructional videos. All right, with that, I'm going to take a little time here to get something to eat, and then I'm going to do my my midday market review or midday watch list build. And I'm going to go and throw a little shade at Kramer maybe, but I'm going to take and analyze their top 10 picks and see what we can come up with for swing trades on that. And I bet you we get 1 or 2, but next week is going to be very tricky to swing trade. So I might not even come up with any really good setups that look good into next week. Next week's going to be kind of one of those days or one of those weeks where we've got a holiday in the middle of it. We've got a short day in the beginning of it. And then realistically, we get 2 decent trading days out of it. So I think the week after that's going to be where a better set of plays is going to come from. But next week, we'll probably get a good list of setups that come to a point where they can start to break out of a range or something by the end of next week, where we can start seeing some better swing trade setups. So let me go eat. I'll come back at noon. I will put an alert in the chat, and I will get that live on our YouTube channel as well as on Money.net's Twitch channel. So I'll be in both places at the same time, and I'll probably even throw it on my Kick channel at the same time as well. Yeah, I can stream to 3 places at the same time. Why not? And even keep it going in the Discord chat as well. So 4 places at the same time I can stream to. All right, then, guys. I will see you then.
See you, Jeremy.
Have a wonderful lunch until then.